Hello, Zaifa. I want to do a meeting. Okay, please gather all the stuff because I want to discuss about financial stuff at 3 p.m. Okay, thank you. Let's start with the liquidity ratios for 2022 and 2023. Okay, for 2023, it shows that the company increased RM 0.51 cents rather than 2022, which is RM 0.50 cents. In 2023, the company higher ratio reflects the ability to pay its short-term obligation on time. Okay, for 2023, it shows that firms decreased 0.83 times rather than 2022, which is 0.88 times. It shows that the lower ratio reflects the inability to pay its short-term obligation without relying on inventories. Okay, next is in 2022, the cash ratio is 0.14 times, decreasing to 0.13 times in 2023. They show limited liquidity and a slight decline in company's ability to cover short-term liabilities with the cash.
So after reviewing the cash flow statement, I have identified a few key issues. So the first one is excessive inventory costs. We have more stock than needed, tying up cash that could be used elsewhere. So the second one is delayed customer payment. Customers are taking longer to pay invoices. It slowed down our cash inflow. Then the third one is high operating expenses. While necessary for operations, some non-essential costs can be reduced. So to address this issue, I recommend the first one is reducing inventory levels by implementing better demand forecasting. So the second one is strengthening credit collection policies to speed up payments. And the last one is reviewing operating expenses to identify and cut unnecessary costs. So these steps will help us to free up cash and improve our liquidity. So that's all for me.
I see a major issue with our current credit terms. They're too lenient. Some customers are taking advantage, delaying payments unnecessarily, and that's hurting our cash flow. To fix this, we need to tighten our credit policies, especially for clients with a poor payment history. Stricter credit evaluations will help reduce risk and ensure we get paid on time. On top of that, I propose implementing automated reminders for overdue payments. These reminders will help speed up collections without adding to our workload. With a more disciplined approach, we can improve our cash flow and maintain a healthier financial position.
Thank you, Mr. Uzaifa and CFO. Transparent communication is essential during challenging times. I would like to share our plan to address the current financial concern. First, we acknowledge this issue. We are aware of the liquidity concern and we want to assure you that we are taking proactive steps to address them. These challenges are real, but we are fully committed to overcoming them through decisive action. Second, we emphasize our strategy. Our focus is on strengthening the company by reducing inventory level, improving receivable, and tightly managing expense. These measures are designed to optimize cash flow and stabilize operation. The third one is we reassure our stakeholders. Despite the current financial hurdle, our brand remains trusted and resilient. Our long-term stability is underpinned by strong fundamentals, a loyal customer base, and a track record of navigating challenges successfully. Last but not least, we are committed to transparency to maintain trust. We will provide quarterly updates on our financial performance and the progress of this initiative. We want our stakeholders to have full confidence in our direction. By focusing on this figure, acknowledging the issue, implementing the effective strategy, providing reassurance, and committing to transparency, we aim to maintain your trust as we move forward together. Thank you.
Just to add context, I have researched our industry benchmark. Competitors maintain a current ratio of at least 1.0 and a quick ratio around 0.8. We are significantly below this level, which raises red flags for investors. Improving our liquidity matrix must be a top priority.
Agreed. By focusing on targeted marketing, cost reduction, and automation, we can build on our strengths and address the areas holding back revenue growth. Moving to our second discussion, which is the leverage ratio. Okay, in 2023, the company increased by 0.71 compared to 2022. The company is bad at managing its debt as years pass by. So, this indicates higher financial risk and vice versa. In 2023, it shows that the creditors provided RM 1.46 for RM 1 provided by owners. The creditors' position is more risky compared to the owners. So, the interest coverage ratio shows how well a company can cover interest expenses with EBIT in 2023. It dropped to 8.55 due to higher interest expenses. While still strong, the decline signal reduced financial flexibility.
This is a tricky situation where we technically have the capacity to take on more debt. Too much leverage could hurt our financial stability. It would increase our obligations and could limit our ability to borrow in the future if needed. Instead, I'd recommend considering equity financing. Yes, it does dilute our ownership, but it's a much safer option for long-term growth. It reduces financial risk and keeps us flexible for future investment. If we want sustainable expansions, we need to balance risk and reward carefully.
I agree. Industry benchmark for startup suggests keeping the debt to equity ratio below 1.0. Exceeding discount signal financial instability to investor and lenders. Equity financing might be more expensive upfront, but it ensures sustainability.
Alright, so I would like to add that taking on more debt could limit our operational flexibility. For instance, we might need to prioritize debt repayments over growth initiative. Equity funding, on the other hand, allow us to maintain focus on innovation and expansion.
Let's also consider the messaging to our stakeholders. If we choose equity financing, we must emphasize its long-term benefit, like reducing financial risk and strengthen the company balance sheet. This approach will reassure the investor about our commitment to sustainable growth.
Great insight, guys. Based on this discussion, it's clear that equity financing is the safer and more strategic option for our expansion plans. Okay, next we look into efficiency ratios. Okay, the ratios increased from 3.45 to 4.23 times, indicating that the company sold its inventory faster in 2023 compared to 2022. A higher inventory turnover suggests better inventory management, reducing storage costs and the risk of obsolete stock. In 2022, the receivable turnover ratio is 8.45 times, which is more higher than 2023, which is only 8.46 times. A higher ratio indicates that the company is quicker in collecting its receivable, which improves cash flow. Next is in 2023, the asset turnover ratio is 0.70 times, which is more higher than 2022, which is only 0.70 times. A higher ratio means that the company is making better use of its assets to drive sales.
The improved inventory turnover is a good sign, but we need to be cautious. Excessive inventory levels can increase holding costs. I recommend implementing just-in-time inventory practices and regularly reviewing stock level to avoid overstocking or shortages.
Our declining sales are on another area of concern. One issue is that our marketing campaign aren't reach the right audience. I suggest we launch the target promotion and leverage data analytics to personalize customer experience. This could drive higher sales and improve turnover ratios.
Improving workforce productivity is also crucial. A well-trained team can directly impact operational efficiency. I propose investing in training program focused on customer service and process optimization.
To add, our efficiency ratio are improving compared to last year, but competitors are still ahead. If we enhance inventory management and sales strategy, we can catch up and potentially surpass them.
Excellent points. By optimizing inventory, improving sales tactics, and training our workforce, we can significantly enhance our operational efficiency. Okay, lastly, let's look into profitability ratios. In 2023, there is an increase in the gross profit margin by 45.88% from 2022 which is 45.20%. This indicates that the company is more efficient in managing its cost of goods sold. In 2023, the net profit margin has increased by 12.38% from 2022, which is 10.16%. This shows that it suggests better cost control and higher profitability. In 2023, the company showed a higher ratios of 09.09% compared to 2022, which is 0.07%. This indicates that in the 2023, the company has higher return on firm investment than in 2022. In 2023, the return on equity is higher than 2022, which is 31.63% and 22.43% respectively. This shows that in 2023, it has a higher return to shareholders than 2022.
Our marketing efforts haven't been effective enough to drive revenue. I recommend expanding digital marketing campaign and offering customized promotion to attract more guests. Partnering with travel platform could also help boost visibility.
Reducing operational costs is another key area. Automating repetitive tasks and renegotiating supply contracts could significantly improve profit margins without affecting service quality.
Our profitability ratios are above industry average, but we are spending more on marketing than competitors. Reallocating resources to cost-effective campaigns can maximize returns.
Let's conclude our discussion today. Through today's analysis, we developed actionable strategies to address liquidity leverage, efficiency, and profitability challenge. I am confident these steps will significantly improve the financial health of these companies. Thank you for your all contribution. Thank you.